Statistically, 50% of high net worth individuals don't have a plan today. Can you believe that? I listened to the big money, and guess what? They were right most of the time. The smart money was the place to be.
I think a lot of people perceive alternative investments as being even higher risk than the stock market.
See, that is the biggest mistake.
Yeah. What would you say is the biggest difference between investing 40 years ago versus investing in today's environment?
That is a great question, and it's about management. It's not about what people say, it's about their track record, their sincerity, and their reputation.
Welcome to the Capstone Convo. This is our podcast for Capstone Financial. I'm Tyler Stone, the CEO and founder of Capstone Financial and Capstone Fund 5. Here today, we're with Robert Pachter, who was a financial planner in New York City for 30, 40 years, and we'll be talking a little bit about investing, alternative investments, a few other things. So welcome to our podcast. Robert, good to see you here, and welcome to our show.
Well, thank you for the invitation. This is really a beautiful studio. I want to tell you, when you gave me the opportunity to talk to your network, I said to myself, what would they really like to learn? And yes, you wanted to mention alternative investments, but before we get into that, there's a real factor that anybody that's managing money, significant money, as a matter of fact, I used to manage $2.5 billion, so I was in the top of the industry. But in order to get there, you have to plan for people. It's one thing if you're going to go flying someplace and the captain comes on the intercom and he says, well, I'm sorry, everybody, but I don't have a plan. Well, how does that make you feel, Tyler?
Right.
I mean, that is so silly.
Would you ever get on a plane with the captain not having a flight plan you were talking about?
I would not like to do that at all. It wouldn't make me feel comfortable. Just the same, you went to college and you went to, you planned for that education, and that education took you to sitting in that chair today. Without that education and that opportunity, you wouldn't be sitting there. And I can go on and on and on about finding your significant other, about your house, about all the things that you plan for. And when you do so much better. Statistically, 50% of high net worth individuals don't have a plan today. Can you believe that?
So 50% of high net worth individuals don't have a financial plan, you're saying?
A formal financial plan. Yeah, these are government statistics. And so we find that when we do a plan, people can see the bigger picture first, and then we can tell them how much stocks they should have, how much alternative investments, how much bonds, how much hard money funds they should own, things like that, and art, and you can take it from there. But, I learned this secret right in the beginning of my career. I was 23 years old.
Wait a minute. Wait. Are we telling secrets today?
This would be number one.
Number one secret for the day. Okay, 23 years old. All right.
And this takes me my entire career from this one secret. So this is the most powerful statement and information I can give all of your people that are listening today. So listen to this. So I was in the Army Reserve, and there was 5 of us that we worked really hard and earned a pass for the particular day. And we all got in a car and we went to, believe it or not, a horse track. That's what the boat was. We want to do that today. And so we got out of the car and we went to the clubhouse and we did our thing and, bet here and a bet there. But the process was the most important. It's always about the process. So they all made their bets. We got back to the car and went around the car and said, how'd you do today? How'd you do today? How'd you do today? And you know what happened? All 4 of the other guys lost. And I said, I'm so sorry to hear that. They said, Robert, how did you do? I said, well, I'm almost embarrassed to tell you, but I won. Well, really? How did you do that? I said, I went to the $100 window. And I listened. I kind of hid behind the curtain, and I listened, and 70 to 80% of the $100 bettors were betting on one horse. Who are these people? They were owners of horses. They were trainers. They knew so much more than you and I could ever even figure out.
Right.
So rather than betting on a name, how the horse took care of itself, what the looks of the horse was, I listened to the big money. And guess what? They were right most of the time. So I would take that information and go to the $2 window where I belonged and did my thing. And I was able to truthfully say to everybody in the car, I was the only winner. So I took that information and I used it my entire career because I follow the big money. And many pools of large money, smart money wins the game. Yeah. Who's the smartest person in the room? That's what you want to determine. It's not about what people say. It's about their track record, their sincerity, and their reputation. Right. That's what I follow.
Coming out of the Army Reserve, how did you get your start in investing or being a financial planner? What was that transition like going from, or were you already doing that while you were in Army Reserve? How'd you get started?
You know, I got started even earlier than that. At dinner time, my parents, my older brother, and myself, we talked about the market every night when we sat down for dinner. So it was fun.
And was your dad a stockbroker?
No,
why was
he
this
wasn't, but my older brother was.
Oh, your older brother was a broker. Okay.
Yes, and he was like number 12 out of 3,000 people at Payne Weber. So he had really established a really national career. So I thought, well, how am I going to do better than number 12? You know, so he was a big thing to try to, but we were always competitive. So anyway, I knew a lot, and I learned a lot more. I met the head of, it turns out, I met one of the heads of Lehman Brothers to start my career, and I was very lucky. I learned a lot of selling processes from that organization, and they put you in a group. And so after the first year with 125 people in my training class, I was lucky enough to finish number 1. And so from there, I was usually basically the first one to come in and the last one to leave. And that's really how you kind of get ahead in the sales organizations.
What would you say is the biggest difference between investing 40 years ago versus investing in today's environment?
That is a great question, and it's about management. You know, in those days, we would take a stock here, a bond here, and a fund here, but really have no idea how it's all going to fit into a formal plan. Now, today, we do this plan, and we look at it in 3 different areas. We look at estate planning techniques, how to set up your accounts in the most tax-efficient way. An asset allocation model, which means what percentages of stocks, bonds, cash, and alternatives should a person have? And lastly, a retirement analysis. You want to know. You work every day. Every time I talk to you, you're busy doing something, and you know I have to ask for a favor for you to come to the phone to talk to me, other than me giving you money. But anyway, that's what we do. I call it the EAR, ear listening approach: estate planning, asset allocation, retirement analysis. We do that, and then we can talk about any category that fits into your plan, like alternative investments. So we've got to understand, where are we today? Where do we want to go? Meaning, what's inside of our plan? And are we set up for days like this, days like other things where your investments and alternatives have no bearing, no correlation to the general market? So it's a great feeling to have that category covered.
What would be the biggest piece of advice today's Robert would give the Robert of 30, 40 years ago starting out?
So in the old days, it was about, what can you do for me today?
Yeah.
But how does that fit into your plan? If you really think about it, it's ridiculous to use people like that who don't look at the bigger picture.
Yeah.
Holistic investing is more important than anything else you can possibly do.
Right.
Today, we can custom tailor your investment choices and give you the potential upside that you're looking for to create the opportunities of this plan versus giving you too much leverage, meaning too much risk or not enough risk in order to meet the goals that you want for yourself. So you tell me what you want, and I can easily put it together, or I can make suggestions until you are sure of what you want.
How do alternative investments fit into that plan?
See, this is the most fun to talk to. And this goes back to 2001, I was presented a fund opportunity from Blackstone. So Blackstone is the largest asset manager in the world today, and they have the most alternative investments. So I already knew this up front. So what they do is they buy private companies. They put all of their low-cost capital together, put all their management teams together, give all their mental resources to these companies, and presto bingo, 3, 4, 5 years later, they don't even look like the same companies, but they're operating so much more efficiently, and they're making so much more money. And then they take these companies public. So you start with private companies. So today the market's crashing. Your private companies are not crashing.
Yeah.
And you can just like sit back and say, oh, my financial advisor really took care of me. He protected me on a day like today. Not only did I put all my clients in this particular fund, it turned out this was the #1 fund that Blackstone ever put
did.
out. This fund lasted for 20 years. They averaged 24% a year
Wow.
for about 20 years. Now, I'd like to teach you this one principle, and that's called the rule of 72. Have you ever heard of that?
Yep.
Maybe for the few people that haven't heard about it, you take the percentage gain that you get,
Yeah.
and then you divide that into 72, or you have 72 divided into the percentage. Actually, you have the percentage divided into 72, and the answer is how many years it takes to double your money.
Right.
So here we have 24%. Divide that into 72, and the answer is about 3, right?
Yep.
Every 3 years, with compounding, your money doubles.
Doubles your money.
And so
Yeah.
now you can see how valuable that is. So if you do the math, this is like 6 doubles
Right.
on
In the
let's say
20 years.
$100,000. So your 100 turns into 600 with a great investment.
No, it doubles more than that. It doubles to 200, then doubles to 400, then doubles to 800, then doubles to 1.6.
Well, I was doing simple interest.
So-
Yeah, we want to simplify this for those that can't really do it as fast as Tyler Stone, of course. Yeah.
What kind of alternative investments do you see appropriate now? Maybe what you're in, what you think are good opportunities in today's market?
Well, if you look at the market today, what's the #1 category out there?
AI and technology.
That's right.
Yeah.
That's a great answer. So there are so many funds that have come out today. Some of them have never had a down year. Some of them beat the market by 2, 3, 4, 5, 6 times what the market gives out. So you have to balance who these people are versus your plan.
What was the first type of thing that got you attracted to alternative investments?
This is really one of your best questions yet, because you'll find everybody's used to investing in mutual funds.
Yeah.
So the best mutual fund people, that could be a male, could be a female managers, but the best ones, they're only there for so long because they're so good. They've taken their money, they've taken their profits, and they've opened up their own funds in terms of hedge funds, so that they can literally, excuse the expression, they can invest for the market go down or the market could go up.
Right.
So take yourself back 20 years ago, and you saw General Motors, the bread and butter of our economy, faltering. They couldn't keep up with the competition.
Right.
So you saw General Motors at 50, then you saw it at 45, then 40, then 35, 30. The handwriting was on the wall, and obviously at the end, it went to zero. They went bankrupt.
Right.
So the market allows you, and managers do this, where you can sell first and buy back second. So Tyler, tell me, if you sell at $50, like General Motors was, and you buy back at $20, what have you actually done?
You've shorted General Motors.
Yes, and what else?
Made $30.
Made $30. Why?
Yes.
Because you sold first and you
Right.
bought back second. You bought at what price?
20.
And you
Sold at 50.
it sold at 50. The market is the only place that allows you to go in a door and do it the opposite way that most things work.
Right.
Oh, so you,
But at what point did you start looking at alts,
and
as we call
yes, so that's the point where I started looking at them. Why are these people leaving? What are they doing with their time? Are they really that good? And I saw how good they really were. They're making so much more money in their alts than they were in their regular funds for general population. Well, guess what? things have turned around so much. I was early in the game, and I was very lucky to get in the game early because I was right. The smart money was the place to be. These are the smart people. These are the
Just
smart,
like at the horse track.
It was, but in a different sense. But it's exactly the same thing. Follow the money, but be sure you know what you're doing. So I was sure that I studied these people in regular kind of funds. They were great.
Yeah.
But in alts, they were so much better. That's why they changed. And now some of these people are billionaires. I can name some names, but I'm following the smart money always. And if alts led me to the smart money, and one after another. So not only did I invest in like a Blackstone, but I invested people that knew biotechnology. If you look at the market on a daily basis, I mean a daily basis, not monthly, not yearly, but on a daily basis, the majority of the big moves are always biotechnology. But who knows about all this stuff?
Yeah.
I mean, there are people with 2 PhDs, 2 doctorates, and some other degrees that specialize in biotechnology more than you and I could ever know. But if you know which managers are the best, so if we manage the managers, our clients really win.
Right.
And that way our expertise is shown, but I don't have to waste my time worrying about this molecule is going to work with this molecule. I want performance for my clients, but I want risk-adjusted returns, which means lowest risk possible with these categories is hard to find. These people know how to produce and to show it to our clients.
Yeah. When we're talking about risk, how do you evaluate risk in general? But then also, there's, I think, a little bit of a misnomer in that traditional investments like the stock market is low risk compared to alts. No one's going to tell you that the stock market is low risk, but I think a lot of people perceive alternative investments as being even higher risk than the stock market. So,
see, that is the biggest mistake that individual investors make that don't have the full knowledge of what the market has to offer.
Right.
I mean, it is so glaringly a mistake. The bottom line is investments, whether they're stocks or bonds or so forth, everything carries what's called a beta.
Yeah.
A beta is the risk of the security. The S&P 500 has a risk of 1. So just remember that. And then anything under 1 is lower risk, and anything above 1 is higher risk.
Okay.
So a lot of times the alts have little to no correlation to the general market.
Right, to the S&P 500.
So would that be more risk or less risk?
Right.
It'd be less risk. And so they can even tell you how much risk they're taking by how much they're hedging the market out of their equations. So it's about knowledge. It's about using people with the greatest knowledge you can in order to get the best performance potential.
Right.
Some people make mistakes and they don't see the market the way it really is. But I tend to look for the top people, lowest risk, and over time, it's really worked out spectacular. But having the plan is that important, even more important than the specific investments. But specific investments carry you to your goals.
So in the alternative investment world, or in alts, what would be your opinion of the higher risk or more volatile alternative investments, and what are like the less risk, the lower beta alts?
You start out by looking at the category you're talking about. So bonds, you would think that they have the lowest amount of risk.
Of traditional investments,
right.
Yes.
But even alts too. They'll have a lower risk model. But it doesn't mean that they're always successful. It doesn't mean they're making money every year.
Right.
But generally speaking, if you pick the best, they have a way. They have their own secrets of how they do it.
Right.
And like there's one company that I deal with that has 50 PhDs in one giant room talking about the risk of each particular investment they make.
Wow.
And they put them into a fund. And this one is the best. But now, today, you need $10 million to get in their door.
Wow.
But if you use the right financial advisor, they can show you places where you can get in for $1 million, maybe 500, maybe even 100,000, so that you have access to the very best minds and not hurt your asset allocation model.
Right.
We have basics never go out of style. So we have retirement analysis, we have asset allocation, and we have and security selection are all so important to get you to your goals. It doesn't make sense if you're a person that has so much assets. I see that you're taking too much risk. I'm going to show you in paper form, in black and white and in color charts, exactly why you're taking too much risk in order to meet your goals.
Right.
Why take more risk than you have to?
Than you need to, yeah.
Yeah. So, I mean, if
Gotcha.
your wife expects for you to bring a Lamborghini home every day, then that's a different story.
Yeah.
Tyler, I know you asked me before about risk and how it applies to investments. We have a way of looking into each individual security that goes into a fund or into an investment, and we can assign it what I say is a beta. A beta number. The statisticians, they do this easily. We have screens that literally put up a beta right on a screen right in front of you. I can show you, like from Yahoo Finance, what the beta is on any particular.
I've seen beta numbers when you look at a stock fund or whatever.
But it's very rare that you'll find a manager that maybe never had a down year or maybe has one down year in 20 years. They have secrets.
Yeah.
They have their style. They have 50 PhDs in a room knowing what they're doing more than you do. That's what's really important. And how do you think as an individual investor you can be competitive against all the competition out there?
Yeah.
It's impossible. So when I hear, oh, well, I do my own investing, I kind of laugh, not at the person, but at the process. It just is ridiculous knowing that I am more than 50% confidence that, a sophisticated, very well-schooled manager can beat them very easily.
Very easily. There used to be the 50 years ago, the term modern portfolio came out, and that was always 60% stocks, 40% bond type investments. But, these days you have people talking about different numbers and how to incorporate alternative investments in there. What would you think would be a starting point or a typical allocation for alternative investments in a newer portfolio?
The big money today, and what is big money?
Yeah, what the hell is big money? Is that over $1 billion?
Well, like whatever fits in your pocket, that's big money.
There you go, yeah.
But on the other hand, big money is things like funds, big funds.
Hedge funds.
Big funds. You've got insurance companies that invest their clients' assets.
I forgot
and
about
you see the biggest buildings in any city, they say insurance companies on the top of them.
Right.
So these are big investors coming into the market. And alts, maybe 20 years ago, it represented 2 to 3% of the big money. Today, you'll see in black and white in the papers, they're now going up to 25%.
Oh, wow.
And guess what? The traditional stocks, they've gone from the 60%, like you just mentioned.
Yeah.
Now they're at 15%.
15% only in the stock market.
15%. Now, I'm not talking about individuals, that you talk
talking about the big money
at the bar. I'm talking about the
Blackstones of the world.
The big money, yes. And so, as a matter of fact, I had a conversation with Blackstone very short amount of time ago, and they're putting 25% of their money into private income ideas.
Gotcha.
So, let's say...
give me an example of a private
I'd be happy
idea.
to. So, your best friend is a successful business person, and they go to the bank, and they've really borrowed as much as they could from the bank. And maybe the bank is loaning them out at 6, 7, 8%. Okay, so now they have another project they want to do, but they need capital.
Yeah.
So what is that all about? Well, now they're going to have to pay 10, 12, 14% for money.
Right.
And because sometimes it's a very short amount of time, that makes sense.
Yeah, because interest rate, you're not too sensitive about interest rate if you're only borrowing it for a little amount of time.
Exactly. So what happens is your friend that's a successful investor, he'll start to use the alts more than he ever did before because he can't really get it anywhere else.
Right.
And he needs it, and he knows what to do and how he's going to make money with it. So as long as he has the plan
Right.
to make the money and he's been successful, it really covers him for making giant mistakes.
Yeah, you're talking about the investor that's lending my friend the money,
Yes.
or the businessman friend that's borrowing the money.
Actually, the businessman that's borrowing the money.
Yeah,
Because
gotcha.
you don't want your clients or your friends to make mistakes.
Right.
But if they have to in order to finish a project, then they're going to have to do that. So, or the contrary is, let's just say they just sold in 2006.
Mm-hmm.
Remember that time? Do you remember what was going on then?
2006 was like kind of one of the peak run-up time periods of the housing market.
Yes,
Yeah.
yes, real estate. So I had a client who had pieces of 100 different buildings throughout New York City.
Oh, wow.
One day, his partner woke up, called him, and said, "You know what?" His name was Lewis, by the way. "Lewis, I don't really want to be in business with you anymore. We're doing great. We have a spectacular net worth, but we don't have any cash to
Yeah.
really enjoy our life. I propose that we sell our positions to the REITs, the
Yep.
real estate investment trusts." They went out, they did shopping, and they found one REIT that bought everything they had. Sold at the end of 2006. He comes to me and he says, "Robert, I never had this liquidity before in my life. I have a 5-story brownstone in New York City, and
Right.
Everything's fine in that way. But now I can really do what I want to do. Can you put a plan together for me?" And I said, "Oh, I would be happy to, Lewis." Took me 2 or 3 weeks to really come up with a specialized plan for him. He went to 2 of the other competitors, and
Yeah.
you have to know that very ultra high net worth clients are going to do that to be sure they're in the right place. Even
Right.
though one of my best clients gave him my name to come to me,
Right.
2 or 3 weeks later, he called me and said, "Robert, do you have the plan in place?" I said, "Yes, please come in on a Thursday." Great. He comes in. He looks around. He says, "Robert, you're by yourself." He says, "I have to be honest with you." He says, "I went to 2 of your competitors, Goldman and Smith Barney. One company had 4 people. The other company had 7 people. You're sitting here by yourself. Why
Why is
don't you
that?
have a giant team behind you?" I said, "I could fill the room up, but I knew exactly what you need because you hardly have, with all these millions, you hardly have any IRA money, any future money that's protected by the government's taxes.
Right.
So on day one, we're going to put $250,000 back for you in a retirement account, and the government's going to fund it by 30 to 50%. So on day one, I'm going to save you $75,000 to $100,000 without buying any products, doing it just because
Just
of the
tax
knowledge."
savings.
Did you hear that with the competition? No, Robert, nobody. And this guy, believe it or not, he was a college professor of mathematics and statistics. He was one of the most smartest guys I ever met in my life. So ultimately, I built a team for him. I got an estate planner. I was the financial guy and insurance guy, and we got him a new accountant because he had outgrown his accountant.
Right.
And his life is so much different today than it ever was.
Gotcha.
That's how the industry works. Typically, people grow, but their people that are around them don't grow as fast,
Right.
and they need current information.
Yeah. Their team of advisors or accountants or whatever are not growing as fast.
That's right.
Yeah. Yeah. Yeah.